When Bitcoin pierced the $76,000 mark this weekend, a massive wave of capital rushed into the market. Then, the price violently reversed. Traders who bought the breakout were instantly caught off guard, their positions bleeding out in a matter of hours. This is a classic psychological trap. Retail traders are conditioned to hit the long button the absolute millisecond a major resistance line is crossed, reacting to raw adrenaline instead of structural confirmation. Professional traders operate on a completely different framework. They know that true market shifts are never validated on lower timeframes. A macro trend requires macro confirmation. This diagram illustrates the mathematical threshold professionals use, known as the 3-day rule. Watch the price action here. The asset pushes up, breaking the resistance level, but the buying pressure exhausts. The actual body of the candle shrinks and closes strictly below the barrier, while the peak leaves behind a thin line, or wick. That wick, above $76,000, is meaningless noise. It is a temporary excursion designed to trigger algorithmic buys and liquidate early short sellers, while the true, solid body of the asset remains entirely trapped underneath the resistance. To confirm a genuine macro reversal, a strict 2-step sequence is required. First, a full 3-day candle must officially close above the resistance line. Second, the price must hold that exact level on the next candle, validating the former ceiling as a completely new support floor. Bitcoin has completely failed to produce either of these signals. Over the last multiple days, every attempt to hold the $76,000 level has resulted in a rejection. Because this breakout remains entirely unconfirmed, the massive bearish divergence we've tracked on the weekly time frame remains fully active and in control of the market structure. As a direct result, we are charting a heavy weekend pullback. The price is currently shedding its recent gains, bleeding down toward the immediate safety net sitting at the $73,700 support tier. Treating a temporary price wick as a definitive trend reversal is mathematical suicide. True breakouts require undeniable, high-timeframe structural validation before you risk a single dollar of capital. While the short-term chart dictates this immediate pullback, the broader market is being manipulated by massive invisible magnetic forces known as liquidity pools. This chart maps out exactly where the capital is clustered. Looking at the vertical price axis, you can see a massive pulsing bar at the top. This represents a heavy cluster of upside liquidity sitting completely untouched at $78,500. Below the current price, a smaller but highly dangerous liquidity zone sits between $72,000 and $73,000. Right now, the digital indicator bounces rapidly between these two targets, caught in a mathematical stalemate. Technical charts alone cannot predict which pool the market will sweep first. We need an external, macroeconomic catalyst to break this deadlock and provide directional volume. That catalyst is the United States stock market. Traditional equities have recently hit all-time record highs, and the entire cryptocurrency ecosystem is now tethered directly to this momentum. If traditional equities open the new week with continued strength, it injects the required systemic momentum for Bitcoin to push upward and finally sweep that $78,500 high. Conversely, if the S&P 500 flashes weakness or crashes at the opening bell, the upside target is instantly invalidated. That lack of confidence will drag Bitcoin down to flush out the $72,000 floor. For the next 12 to 24 hours, crypto is sitting in a waiting room. The traditional stock market open will dictate the overarching macro direction. Trading this current weekend chop without factoring in the opening volume of the US equities market is flying blind. Macroeconomic correlation overrides micro-technical chart patterns every single time. This macro correlation extends far beyond Bitcoin. We can measure the health of the broader altcoin market by tracking the Bitcoin dominance metric. Right now, Bitcoin dominance is sideways. It is entirely neutral. Capital is not actively rotating, and the market is locked. This diagram applies our 3-day rule to Ethereum. As Bitcoin hits its ceiling, Ethereum tracks the exact trajectory, slamming into an identical wall. Ethereum must confirm a strict 3-day candle close above this $2,400 barrier, or a multi-month bull run cannot begin. Until that happens, Ethereum is caught in a pullback, falling back toward a critical support band located between $2,150 and $2,250. There is one piece of optimistic microdata. On the 4-hour time frame, Ethereum's relative strength index is rapidly plunging toward oversold territory. If this weekend weakness continues to drag prices lower in the immediate hours, hitting that oversold baseline makes a short-term mathematical bounce highly probable. Ethereum is acting as a proxy for the entire ecosystem. No individual altcoin will independently break its macro resistance wall until the broader market receives a synchronized, volume-heavy push. Knowing these exact levels is useless if you execute poorly. During a volatile market open, retail exchanges suffer from massive slippage and terrible spreads, entirely destroying your entry price. Professional execution requires a strict, high-liquidity environment. You need reliable platforms like BingX that maintain tight spreads even when the market violently reacts to the opening bell. This schematic layout breaks down the exact descending tiers driving XRP's current descent, mirroring the weakness across the rest of the altcoin space. XRP is perfectly playing out a 4-hour bearish divergence. It is currently bleeding out, descending steadily toward a massive macro floor sitting at $1.30. On its way down, the asset has to carve through a descending staircase of micro supports, tracking down through 1.38, 1.35, and 1.32. Solana is following the exact same rules. It suffered a flawless down-to-the-cent rejection strictly at its $90.70 resistance ceiling. That rejection forced Solana below its $85 support, setting up the next major defensive line clearly at $81.50. Meanwhile, Chainlink is caught in agonizing sideways trap, endlessly ping-ponging between a $7.90 floor and a stubborn $10 ceiling. The market is going to turn highly volatile the second the traditional stock market bell rings. Subscribe and turn on notifications right now so you have the data you need to survive the resulting liquidity sweep. The entire Whale Playbook boils down to a single unbreakable law: never front-run a major resistance level without a confirmed 3-day candle close. True market direction is dictated by patience and macroeconomic confirmation, not the frantic, liquidating noise of lower timeframes. Master your risk management now, before the opening bell decides the next major sweep.